Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I'm the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm trained as a macroeconomist, and I'm a certified financial planner. So today I'm here again with Patrick Shea. Pat, great to see you.
Thanks for having me, Drew.
So Pat and I are going to start a multi-part series. And by the way, to back up, Pat is a wealth advisor here with Benson Wealth Management. But Pat and I are going to start a multi-part series on the financial crisis. And I feel like the events from 2007 to 2009 were watershed moments, obviously, for the United States economy. And I think thoughtful financial advisors and wealth managers should have a basic understanding of how the crisis works in terms of understanding risk, in terms of understanding complex financial instruments, because I think it'll make you a better wealth manager and wealth advisor if you have a basic understanding of this period in history. I also think it's good to understand the Great Depression, and that's probably a series I'll do in the future as well. So this will be a multi-part series. One of the reasons that we thought of doing this series is that clients, this happened recently, a client came in and said, "Hey, Drew, what did you think of The Big Short?" People are curious about a lot of these movies, and that's usually the one access point that our investors have, or our clients have, to the events of 2008 and 9. Many of them lived it, but then they're now watching a lot of these movies, trying to actually unpack and understand the financial crisis. So one is we're going to dialogue about three major movies, The Big Short, Margin Call, and Too Big to Fail. We're going to talk about The Big Short and Margin Call and the financial instruments that are referenced in both of those movies. That'll be for today's episode. Our next episode will be on Too Big to Fail, which is predicated on a book written by Andrew Ross Sorkin. I read that book. I also read The Big Short. The Margin Call is not based on a book. It's just a movie, and we'll talk about that today. The other thing we're going to do today is, I think if you really want to get your head around the financial crisis, there's a lot of parts to this. This is why we're doing multiple episodes. But you have to have a basic understanding of the financial instruments that led to the financial meltdown. And so today, Pat and I are going to really help you as a listener understand what a synthetic collateralized debt obligation is, what a credit default swap is, what a mortgage-backed security is, so that you have a better understanding when you go and watch the hilarious movie The Big Short. You'll have at least a better understanding of what's actually happening. So let's start there, Pat. And am I missing anything about this series that you'd want to add?
Our guests, I think.
Yeah. So that was the other thing. So obviously, you and I are going to do a lot of episodes together regarding the crisis, particularly around the movies. But I already lined up a scholar, a world-renowned banking scholar, that will give us a much deeper understanding of how the crisis works. His name is Charles Calamiris, and we're working on getting him scheduled now. And so not only are you going to learn about sort of the actual events that happened during these 7, 8, and 9 time period, but there's so much banking regulation and so many political dynamics that actually had been cooking for decades, if not centuries, that then led to the financial crisis itself. I'm in the middle of reading his book, which is phenomenal. And so I am looking forward to interviewing people like Charles. We're also currently, through our connections of other scholars, trying to get more PhDs in the door to actually explain to you, the listener, what happened during the crisis. So you're not just getting our opinion, you're getting some outside experts that hold doctorates. You're getting their perspective as well.
Great.
So let's start with the instruments. Mm-hmm. Okay, so in The Big Short, there were several instruments that were referenced. So let's talk about the mortgage-backed security. So I'll start with you, Pat. What is an MBS or a mortgage-backed security?
Right, that brings it down to like the actual asset that was most important in the whole meltdown, right? Real estate. So a mortgage-backed security is, most people have a mortgage, and then their lender will take that mortgage and sell it to a bank, who will then sell it to an investor. And they don't do it one mortgage at a time, right? That would be like tiny investments, it would be they're doing this on a grand scheme, on a grand scale. So they package all of these mortgages together, call it 100 million in debt, right? Let's say you owe 300,000, someone else owes 500,000, another person owes 1.3. You bundle that all together, let's say in a package of $100 million in debt, and then you sell the right to those interest and principal payments to investors in what's called a mortgage-backed security. So the security is just like this is a portioned out in investments for investors to enter into the asset, and mortgage-backed is that's the underlying asset, right? So it's basically just letting people invest in, or basically buy bonds from your typical American who owns a mortgage.
Yeah, so basically what you're entitled to is the cash flow from the mortgages.
Yeah.
So say they bundle 100 mortgages together, and let's say of all those mortgages in aggregate, it generated $5,000 of annual income to an investor. Okay, let's say it's $100,000 worth of assets that's leading to a cash flow of basically $5,000
Yep.
per month. When I say assets, really what I mean is outstanding loans, right? So let's say you're getting $5,000 of income per year. What you're actually receiving is and by the way, my math is not right on that, so disregard the 100,000 thing. Let's just assume it's a bundle of mortgages and you're making $5,000 of income to start in year one. All you're really receiving are the interest payments and the principal payments that people are all respectively making on their mortgages. And that income, which would traditionally just pass on to the bank, is actually passing on to retail investors.
Right.
So the packaging of the securitization is basically they're making a new financial instrument that's then tradable on the markets and has an actual tradable value, and it's circulating on the public markets the way a stock would circulate, or a mutual fund, or an ETF, et cetera. That's basically how a mortgage-backed security works. And so a lot of these banks, to offload the mortgages, were then basically packaging, securitizing them, and then mom and pops on the street could buy these things.
Or pension funds and institutions.
Correct.
Yeah.
Yeah. So then it did balloon. Obviously, it was very prominent with these huge institutional strategies.
And to put it all in context, The Big Short begins sort of giving a recap of the 70s and 80s, right?
Yep.
And people are complaining about 7% mortgages right now. But we had a client in last month who was like, 7% is pretty good. I remember when it was 22.
Yeah, that's right.
Because back then, mortgages were paying or were costing a lot more. So it was a pretty good investment. If you're going to make 18% off of a mortgage, and if you think about it, the first thing people pay off, or the first priority for most people is like, I just want like a roof over my head. So mortgages are a pretty safe investment, or the housing market's a pretty safe investment, and they were yielding 18% or around there. Whereas today, you might think of a mortgage-backed security, and you're going to earn, a few years ago, 3%. You're like, 3% on my investment, that's not great.
Right.
Nowadays, 7%, okay, that's not bad.
Yeah.
But now, after 08, 09, like, do we still have the same faith in people's ability to pay their mortgages? After that, that's a different question. But so to put it in context, when this product came out, it was a good buy because it was, it's a safe investment. People are going to pay their mortgages, and it was a healthy return.
Correct. And it was a lot more exciting than the boring sort of utility stocks.
Right.
And I'm thinking of the scene, which I won't repeat, on air.
Snooze.
Yeah, it was a snooze. We'll put it that way. So that was why I think the mortgage-backed security was pretty exciting for people, is because it provided potentially a much better return.
Right.
Right. All right. That gets us to the term tranches and then understanding ratings. So talk to us about what a tranche is.
So a tranche is just the French word for portion, I think. So what they would do is, you have different types of mortgages. You've got adjustable rates. You've got 30-year fixed, 15-year fixed. You've got different sorts of mortgages. And on top of that, you have different sorts of borrowers, right? So someone that's defaulted on their credit card bill or never made their car payments or whatever it is, they're pretty not the best risk to take on, right? Like, I don't really believe that you're going to pay me, but there's a slim chance you will. I'm going to say there's like a 75% chance you're going to pay me back. Slap a C rating on that. That's just a rough sketch. So you basically rate each borrower based on their credit worthiness.
Correct.
So what they were doing is they were taking say they'll take 100 mortgages and then sort it into the type of mortgage, sort it into the rating, and then put them into different tranches or different portions of the mortgage-backed security. So even within the MBS, there were different segments.
Right.
And then this gets to the ratings, right? If they're dividing it by ratings, you've got the triple A's here, double A's, single A's, B's, double B's, triple B's, or maybe it goes the other way. And why the ratings were important was because they were, putting a broad spectrum of credit-worthy mortgages, right? So you had like not so credit-worthy and very credit-worthy mortgages packaged into one security. And what ended up happening was they were giving the whole thing a better credit rating on the whole.
Because it was diversified because there were so many different issues of mortgages.
Which is, I think, a horrible misunderstanding of what diversification means. Sure, overall your risk might be less than if you'd solely gone into junk bonds.
Sure.
But I'm not quite sure that diversifying across creditworthiness is a true diversification.
Well, right. Like it makes me think of say a high yield bond fund, right? A high yield bond fund by default is inherently risky, which, by the way, the pejorative would be junk bond.
Right.
And so these are low credit quality, low credit rating. So anything basically below triple B, and you get into sub investment grade. Yes. Are you like, would I sell an individual high yield bond to a client? Probably not. Just because inherently that has a lot of default risk. Now you can remove a portion of the risk per se, or an aspect of risk can be mitigated through diversification. So if I have 100 of those bonds, yes, the good news with 100 of those bonds is that are all 100 likely to fail? No, it's pretty low. But in a high default environment, maybe 10% of those bonds could fail. So it's nice to have the other 90 to help it out. But you can't get away from the fact that every single one of those bonds is below investment grade.
Right.
And so to then say, well, it's AAA rated because, I mean, if it's all below triple B, you can't slap a AAA on it.
Right.
And that's basically what was happening with these instruments, is because, and again, this is why I think for me and you, Pat, and for anyone listening to this, and particularly if you're in this field, is this is why we have to understand the way people are measuring risk. And what was fundamentally flawed is the way in which they were determining risk and the way they were therefore then rating these mortgage-backed securities. This is where some of the trouble came in, and it was a part of the building blocks that then led to the crisis. Right? There was a lot of other components which we're going to learn about throughout this series. But that was one of the most troubling parts of this. Is like, give me a break. Just because it's diversified doesn't mean you've actually inherently removed the fact that they are all junk bonds still.
Yeah.
So let's then talk about anything else you want to say about tranches and ratings.
There was, though, in The Big Short, there was that one scene where they went down to either S&P or Moody's.
That's right.
And they basically, there was a gross negligence on the part of like the salesman and on part of the part of the investment banks who were, promoting and moving and creating these products, right? They should have been a little more, what's the word? Straightforward about what was in them, right? They could have done a better job educating clients on.
There's a lot of opacity for sure.
But another factor was, so they did go to clients and say like, hey, it's AAA rated, and they weren't wrong. But what was happening behind the scenes was the rating agencies were saying like, well, we give them the AAA because if we don't, they're just going to go down the road to our competitor who can give it to them. And so I think Mark Baum's line was like, ratings for fees, really.
Right.
So you're basically, it's kind of like getting your USDA organic stamp on your chicken. It's kind of like, well, if you pay the fee and you shake the guy's hand.
It's a great way of putting it. And that happens, by the way.
Yeah.
You're right. And you think, okay, this is great. This is helping people. That happens with fair trade coffee. They'll say, oh, this is fair trade. And then you'll find out that none of the money ended up going to a farmer. I actually had a professor who looked into that in grad school. And some of the results were really chilling to me.
Yeah.
Okay. So that then gets us to collateralized debt obligations. I'll take this one since I've been asking you to do all these technical questions. Thank you, Pat. So a collateralized debt obligation, and I spent quite a bit of time researching it. One of the things I will say about this is a lot of people really didn't know what a collateralized debt obligation was. In fact, there's a really great part in the middle of The Big Short. And I won't say which bank, but one of the banks, the CEO of that bank, and I will say, to the defense of this particular banker, they they were not actually in the investment banking world. They got into it after all the bailouts happened. But one of the comments about this particular CEO is he had no clue what a collateralized debt obligation was. So do bear in mind that even some of these titans of the financial industry had a very bad understanding of what these actual instruments were. So even researching it took a little bit of time. Like I had a fundamental understanding of it, but I felt a little bit bad. I'm like, goodness gracious, like I work in this industry. I should know like easily what a collateralized debt obligation was. And then I realized, well, a lot of these people on Wall Street had no stinking clue themselves. Right. But basically it's a fund of funds. So if you think about the mortgage-backed security, and I would equate it to this, is like, say you have an individual stock. Well, you could take an individual stock and buy it in a package form known as a mutual fund or an exchange-traded fund. Well, then it can turn into the mutual fund, then morphs into what is known as a fund of funds. So I could buy a particular mutual fund with a ticker that holds 7 other tickers in there. So each of those 7 mutual funds have stocks inside of them, but I've got a single package that's a fund of funds. The collateralized debt obligation, at least the mortgage-backed version of it, because there's other types of collateralized debt obligations. It could be auto loans, it could be credit cards, et cetera. But this mortgage-backed version of it was basically the fund of funds, right? So you've got the mortgage, which is like the stock, which then went into the mortgage-backed security,
which is like the mutual fund.
Which is like the mutual fund. And then the fund of funds is like the collateralized debt obligation, which was basically a bundle of various types of mortgage-backed securities with different tranches, as you were just describing. So that's my understanding of what a collateralized debt obligation was. Any additional comments to the way I'm describing that?
Yeah, I think there's a lot of a collateralized debt obligation. They're like a lot of people get caught up. No, or not caught up, but we kind of mask a lot of these concepts.
Using technical terms, is that what you're saying?
Technical terms and 3 little acronyms. And,
Yep.
But this, like, I think collateralized debt obligation might be a little bit of a mouthful. And I think one analogy that I've found is helpful is like pawn shops, right? Although pawn shops aren't in most people's day-to-day experience. But, you show up and you're like, okay, I've got my grandmother's ring and I got to go pay so-and-so because of X, Y, Z. And you're like, all right, I'm going to put up my grandmother's ring and you give me $1,000. And then a month later, I'm going to come back, give you $1,000 and I'll get the
That's
ring
the
back.
collateral part.
So the ring is the collateral, right? Like I'm not sure. We usually think of like collateral damage, right? Like something in the Middle East is blowing up and there was collateral damage.
Yeah, this was like maybe an unintended consequence of the fallout of, say, dropping a bomb somewhere.
Right. This is like a little bit different where it's like, no, like this is going to back up my intention to pay you back. And so the collateral in the CDOs were the MBSs. And the collateral in the MBSs were the actual mortgages, of which the collateral was
a home.
Tom's home.
Exactly
Sally's
right.
home. Yeah.
Exactly right.
So it's just getting to the we're going layers and layers and layers of complexity, but not just complexity, but sort of the ripples of effects at stake here just because of one mortgage.
And it all started with the home.
Yeah.
It all started with a physical home, with an address, and the American dream. And by the way, this is something we'll talk about, but the affordable housing push goes all the way back to the 1930s under President FDR, or President Roosevelt. So to your point, like this all goes back to the concept of the American dream and home ownership, which then is a byproduct of, that's why we have mortgages, right? So you can borrow to actually attain the home, and then you see all this financial innovation occurring over time that's leading to different instruments. I think the other description that I like too is asset-backed. So these are all what are known as asset-backed securities. And the tangible asset for all of these is the physical real estate itself, whether it's residential or commercial. Yeah. But there's an actual home somewhere, whether it's Iowa, New Hampshire, Florida, New York, there's a physical home somewhere that's backing up these assets. Right. And thousands, millions of homes that are backing up these assets. So I appreciate you saying that. So the collateral, it really is just a description of the asset itself. So collateralized debt obligation is basically, there's outstanding debts against the assets. The mortgage is basically what it's referencing. Yeah. And the obligation is the obligation to pay. Yeah. But I think that is a frustration, though. Like, we use these nebulous terms, and that came up in, I think it was The Big Short, and I think there was also referenced in Too Big to Fail. it's sort of the frustration that we're using these complex terms as opposed to making it simple and easy for the American public to
And we
understand.
haven't even gotten to synthetic.
Okay, so let's go there. All right. So we got the collateralized debt obligation. Now we've got what are known as synthetic collateralized debt obligations, also known as the synthetic CDO. There's the scene in The Big Short where Mark Baum, also known as Steve Eisman, sits down with a CDO. I think it was a synthetic CDO, basically broker, was my understanding. And
who was supposed to be acting in a fiduciary capacity for his investors.
That's right.
Yet was getting paid by the bank that was building the product.
Correct. So, and Mark Baum, i.e. Steve Eisman, is totally appalled and has some extremely choice words for what a reprehensible human being he actually is. And then they seek to explain what a synthetic CDO is. And that was the scene with Selena Gomez and the economist, Dr. Thaler. Let's talk about that scene. There were a couple of scenes in the movie that I appreciated. I thought that was one of the better scenes in the movie. Yeah. I thought Selena Gomez, as an actress, did a pretty great job of explaining it. And so did Thaler. What were your thoughts on the scene? And then how do you think it was helpful in explaining a synthetic CDO? And then what would be your comments on that?
They did a really good job. In my mind, it's difficult to fuse the simplicity of the analogy with the apparent complexity of the product, right? Because everyone's like, what's going on here? It's actually not that complicated. And the way she described it was a synthetic CDO. Well, let's back it up back to the mortgage, right? So she's there playing baccarat, is it? Rolling some sort of dice game where you're gambling, right? And you think it's pretty dicey.
I don't even remember. I thought it was.
I don't know what game it was.
I thought it was blackjack.
Maybe you're right.
I think it was blackjack, but
either way, high risk, right? Or low chance of success.
Sure.
Statistically speaking.
House always wins.
Yeah. So she's playing that game, but she's on a winning streak, right? So she compares that to like the typical American's ability to pay their mortgage has been going well, apparently. Not actually. So she's saying like,
well, by the way, just to back you up a little bit, the concept was that real estate never goes down because real estate hadn't gone down in many, many, many decades.
Right.
And I'll say this real quick and then finish a thought, and sorry to interrupt, is there's this thing known as the turkey, I think it's called the turkey fallacy or the turkey heuristic. I forget the exact term, but you'll figure this out quickly. If you think about a turkey's life, every day with 100% certainty, it lives. It lives day one, it lives day two, it lives day three, it lives day four, it lives. If you use past experience as being indicative of the future and you're a turkey, that's not overly rational. Because guess what happens on day 60? I don't know if it's actually day 60, but what happens to a turkey?
278 around November.
Okay, is that what it is? Okay, yeah. 60 is pretty short. But what happens is around Thanksgiving, it's done.
Yeah.
Right? And so the fallacy, the reason I like the turkey fallacy or whatever it's called is that you can't use past experience of actually predicting future results at all, because the only experience a turkey had was that it was alive every single day until it wasn't alive. And I think that was the same fallacy that happened with the mortgage markets and with the housing markets. Is like, well, this never goes down. Right. And that's where Thaler, in the middle of that scene, talks about the hot hand fallacy of like, you'll continue to hit a jump shot every single time. And it's going to continue because they have the hot hand, it's going to continue indefinitely into the future. Right. But continue what you were saying.
Yeah, so she was playing blackjack and kept winning. And then she compared her winning blackjack to basically Americans paying their mortgage. It's like, real estate's never going down. I'm never going to stop winning blackjack. And then here's where we got the synthetic CDO aspect. So firstly, the CDO is already betting on those mortgages getting paid, which is those MBSs being paid, which is betting on Tom and Sally paying their mortgage, right? So you're already 3 steps away. But there's actually assets to back that all up. The CDO is backed up by the MBS, which is backed up by the actual mortgage.
So it's 1-to-1, right?
Yeah.
Per se.
Yeah. It's not as though they're making, nebulous bets. So that nebulous. So, but then what's happening with the synthetic CDO is so this woman standing next to the table sees Selena Gomez win 4 hands of blackjack. And she's like, she's been winning a lot. I'm going to bet you other man standing at the table that she's going to win again, 20-1. And he's like, I'll take the bet. Or he's like, that's a good bet. Like, she's been winning. Like, yeah, I'll take that bet. Because the housing market's been winning. So analogously, the housing market has never gone down, at least not since the Great Depression. Like, we're good. Like, that's a good bet. I'll take it. Someone else sees them make that bet. So that's the first synthetic CDO, right? And then someone else sees them make that bet and then says, Selena's been winning, so that bet's probably going to be successful. So you know what? I'm going to bet that bet is going to be successful. So now, and 20-1 again, let's say. And I forget what the multiple was, but this occurred 15 to 20 times?
Yeah, I know. I was just trying to recall that statistic because I had it a few weeks ago.
Whatever the number was, it was absurd.
It got levered up fast.
Yeah. So, and to your point, levered up, right? So you're not...
Well, for every, say, dollar of physical real estate, there were significantly more dollars that was invested in the asset-backed world, and part of that was happening, one, just through pure leverage, which is additional borrowing, but also just through the fact that they were ramping up these synthetic CDOs. The question that I kept asking myself, and I'm asking myself this right now, is why? Like, why did they even have to do this? Why not just stick with a CDO and an MBS?
Well, you run out of houses.
They did. And it was such a hot investment that they continued to run this up. The other thing is the investment banks, such as Lehman Brothers in particular, but Bear Stearns, Goldman Sachs, Morgan Stanley, Merrill Lynch. But we'll talk about the two that really are not here anymore, Bear Stearns and Lehman Brothers. Lehman, for instance, they were heavily levered up on these collateralized debt obligations on their balance sheet with the same premise, right? That this is never going to go down in value. So the market, there wasn't enough homes to sustain the appetite of a market that actually wasn't quite sustainable in the end. Yeah. So I think that's a good way of describing a synthetic CDO.
But yeah, and the point
it's a bet on a bet.
Yeah, bet on a bet. But it's not as though bet goes south, at least there's a house that we can sell to recoup some of our losses.
This is why it was, and this came up, I believe in both the books, but I know it came up in the book, The Big Short, by the actual book by Michael Lewis, is that this is why it became such a systemic crisis, is that it extended way beyond just the value of people's homes. It would have been bad enough if it was even just the value of the homes.
Right.
But the fact that the outstanding securitization dramatically outstripped the supply of homes meant that the crisis itself was dramatically, I'm using a lot of like strong words, but I mean it, right? It really ramped up the systemic risk. And that's, I think, the horrible part of the whole situation is that had we not gone down the path of synthetic CDOs, had Lehman Brothers not been levered, I think it was like 30-1, like had that not occurred, it wouldn't have had such a systemic impact, and the financial crisis would have been a lot more muted, in my opinion, significantly so, in fact. I want to back up for a second because I think it's also important for all these instruments to talk a little bit about the underlying frailty of it. So we talked about the tranches and how some of the tranches, although AAA rated, were not good credit quality people. There's a great scene in The Big Short where Front Point, we're going to talk about these people. Remember when they went down and they started actually going to these neighborhoods?
Yeah, knocking on doors.
Knocking on doors. Then they met with that pretty much a predatory lender. Yeah. And they were talking about the ninja loans. Yeah. And so it was no income, no job. I just read the statistics the other day, and it was just over 2%. So think about this. The average mortgage, there was the average down payment for a mortgage back during the crisis or the lead up to the crisis was just above 2% as a down payment. That's all people were putting down. So if you think about it, because so little equity was actually in the housing market, largely due to the no income, no job loans, the ninja loans, because of that, it was easy for the market to flip upside down, and all of a sudden, people were then forced to then go and foreclose. Yeah. And so there's, as you can see, so many layers of problems that we're building, and it was on this fundamentally faulty idea that housing's never going to go down. Yeah. Okay. So we talked about MBSs, tranches, CDOs, synthetic CDOs. Now let's talk about derivatives, credit default swaps, and I'll take this one. I keep asking you the technical question, and this I think gets to. We'll talk a little bit about the storyline of The Big Short here. So there are four main players, or four I would say storylines. There was Michael Burry of Scion Capital. There was Mark Baum. The real life name is Steve Eisman of Front Point. Then you've got this guy, Jared Vinette, which was played by Ryan Gosling. His name is Greg Lippman in real life. And then you had the GarageBand Hedge Fund, which was the gentleman was the Brad Pitt guy who had partnered with the GarageBand Hedge Fund was Ben Rickert. In real life, it's actually Ben Hockett. So I think the main storyline to understand was Michael Burry, and that is his real name in real life. In fact, I somewhat frequently read his opinions on things. But Michael Burry was a long investor, essentially in his own strategy through Scion Capital. He was kind of an old school Warren Buffett value guy, where he would go out and find, and this came up in the book, he would go out and find great opportunities. He did a blog for a while, and the blog started to take off because he was basically talking about some of his investment decisions, and then other people started to notice that this guy's calls were pretty stinking awesome. And so eventually that led to the genesis of Scion Capital. The interesting thing is that Michael Burry himself really had no background in options trading or shorting. He was a classic long investor.
And he also didn't have a background in finance. Wasn't he a doctor?
He was a doctor, and he he did not like the world of hospitals at all. I think the human carnage was really tough for him because you're dealing with, sadly, a lot of death, and there was a part of it where he couldn't handle the dead people, et cetera. And so he wanted out of that world, and he was very depressed as a doctor. And then he, for fun, because he was a really analytical guy, he started to sort of dabble in researching on stocks. And so he has no financial background. It was all just raw talent and grit, which I think is super cool about him. It's not like he had a silver spoon in his mouth and he went to all the right institutions and had all the right connections. Like, he just was so good at what he did, he caught people's attention. So then, though, he's starting to see issues with the economy, and he starts researching the mortgages, and there's this great scene where he's interviewing that kid, and he's got his shoes off, and he's rubbing his feet. It was pretty awkward. And the guy just wants a job, right? And the first task he gives the kid is I want you to go read the mortgages. And he's like, you mean read the actual? He's like, yes, I want you to read the actual mortgages. So
that are within the investment.
Correct. Which is the mortgage-backed security. What he did through some basic research is he found that because these people were doing things like ninja loans and they were really low credit quality, he realized that the housing market was basically was a house of cards. And he figured it out early in the game. So then what he did is he went to the major investment banks, Morgan Stanley, Merrill Lynch, Deutsche Bank, et cetera, and he created what was known as a mortgage-backed credit default swap. Now, credit default swap has always been in existence, or had been in existence for a long time, but the mortgage version of it wasn't actually in existence.
Because housing will never go down.
Because housing will never go down. So why would you short the most perfect asset class, so the least vulnerable asset class? So he went and sat at one of these big, investment banks, and he said, I want to buy the credit default swap from you. So he basically had them write these credit default swaps. And real simply, it is if the mortgages, if the underlying sort of CDOs or MBSs declined, the bank was required to then, that's the swap mechanism, they were required to pay back Michael Burry. Now, he had to, what the original value was. So let's just say, we'll just pick a number. Let's say it's $1 billion. So if all of the underlying mortgages default on the instruments, the credit default swap would allow him to get the return of $1 billion, and he's paying premiums for the right to reap that reward in the future. So he actually has to pay money every month,
an insurance contract.
Like an insurance, it actually works a whole lot like it would work a lot like a put, right? So a little different than a put, but you have to pay premiums for the right to sell at a higher price, essentially. And so you're getting your money back. Anything else you would want to add about the way the credit default swap was working?
Oh, well, I mean, the reaction of the institutions on the street when he went and proposed these contracts, because it was kind of like it like at the time, if real estate was like a big rock, right? It's not like it's not going to break, it's not going to roll off a hill, it's just like a rock. And he's like, I actually want to buy an insurance contract on that rock. I'm going to pay you premiums, and if it falls apart all of a sudden, you need to pay me the value of the rock. And they're like, it's a rock, it's never going to fall apart, of course.
Yeah.
They're like, you're an idiot, but we'll take free money.
Yep.
And then, we figured out the rock did actually fall apart. Yeah.
So one I would say critique of Michael Burry is that he was early. In fact,
True.
his strategy almost failed. And that became really apparent. You have to remember, even though this is just a great lesson for all of us in the world of investing. Even if you're right, you got to be right at the right time.
Mm-hmm.
And he was hemorrhaging money from Scion Capital because he had to pay all these premiums.
Right.
And he got in, I believe, in 2005. That's what the book talks about.
Right.
The movie doesn't get into some of the time frame. It gives you an understanding that he was a little on the early side. But because he was the one to create the instrument, he was early, and it took a long time for things to start to actually play out, because it wasn't until several years later. And he was burning money. And there's that scene where one of his initial investors shows up and he's like, where's my money, Michael? I want my money back now. Yeah. And, he's getting really aggressive and belligerent with him. Yeah. So it ended up panning out. And at a certain point, he ended up selling. So here's another component to the credit default swap is that, which again, to keep it simple for a listener, it's just they're shorting. Think of it as a short against mortgage bonds, mortgage-backed securities, and collateralized debt obligations. That became the main mechanism to short these instruments. The problem, though, is then there was the fear that the financial institutions were therefore going to default. And if they defaulted, that means that none of the money would have even come back.
They couldn't have upheld their side of the contract.
So this came up in both The Big Short and in Too Big to Fail, that at a certain point, all these financial institutions realized, crap, we're in deep, and they started to hedge their position of being long, and they started buying credit default swaps themselves.
Right.
So Michael Burry actually made money not on the default mechanism. He made money by a secondary tradable market that had formed, and that was the ISDA. Right. So you needed this big institutional, but it's like the big boy table for trading mortgage-backed securities. So he ultimately had to trade off his positions, but they appreciated so much in value that he made.
Right.
I forget what it was. It was like 6x, I think, of his initial investment.
It's wild.
But that was the interesting component, is the way they actually made money, and this was true with Front Point, which we'll talk about in a minute. The way they actually made money is that there became a secondary market for these credit default swaps themselves, because all these banks were hedging.
Right, which was like Jared Bennett saying, like, I'm selling you fire insurance when the house is on fire.
Right. All right, so let's talk about Jared Bennett. So that's another character. So in real life, that was the character played by Ryan Gosling. Yeah. Easily the most hilarious star of the show, for sure. His real life name is Greg Lipman. So for Ryan Gosling, I did do a little bit of research because the movie wasn't very good at explaining what he
was a little ambiguous.
He was a little ambiguous, but the book, by the way, I did research by just actually reading the book, and the book points out what he was actually doing. But do you want to touch on kind of what his role was in this whole sort of series of events in The Big Short?
Yeah, I mean, so he had his own position, right, within the market. He himself was shorting the market once he caught on to the idea.
He was shorting banks, correct?
No, I think he had his own credit default swaps, which he was paying premiums on.
Oh, right, that's right.
And then to cover the premiums, he was facilitating the secondary market in credit default swaps.
He was a market maker for credit default. He was the guy, basically. Yeah. It was my understanding.
So he was going around and pairing up buyers and sellers for these credit default swaps, right? So Michael Burry had them, and then now the banks want to buy them, or other hedge funds wanted to buy them, and Michael Burry wants to sell them, and the garage band wants to sell them. So there were all these people, but like, it's not like you can just go to the grocery store and buy your apple. You're like, where do I go get a credit default swap? And he was actually pitching these to, so he went down to Front Point. He was pitching these to institutions, right? So he was facilitating that secondary trading, which allowed for all of these, the shorters, right, the guys that got in early, to actually reap the benefits of their position without risking the default of the institutions that they were betting against.
Yeah, because there's a scene where he goes to Front Point, which that's Mark Baum's character, played by Steve Carell. Such a great cast,
The
by the
wrong
way.
number thing.
Yeah. Well, no, I'm thinking of the scene when he initially pitches it,
Oh yeah.
and he's using the was that
Jenga.
Jenga? He's using
Yeah.
Jenga, and he's showing the tranches and the ratings. Right. These are
My
the triple
quant.
B.
It's my quantitative.
Yeah, that's the quantitative scene. So there's a point though where, and actually this is true in real life. One of the traders that worked for Carell, right? The Mark Baum character, Steve Eisman in real life.
Right.
He said and he said this to every person. How are you, effing me essentially?
Right.
Like what do you like? Because he always knew that they were going to get fleeced some way because everyone on both sides of the transaction are trying to make money.
Yeah.
So how are you going to? Basically, it was his crass way of saying,
What's
how
in
are
it for
you
you?
making money? And just tell me up front so I know.
Yeah.
And because I think it was a little confusing, it's like, wait a second, you're selling us these, but you think they're,
So he was like, "Isn't your boss gonna
yeah,
like? Why would you have a job if you're screwing over your boss?" Right
yeah, because he was at Deutsche Bank,
Yeah.
which is it was a bit of a scorched earth strategy, but he wanted, I think he was getting commissions to sell it,
Yeah.
right? And I think you said this a minute ago, and that was funding his ability to pay his premiums on his own shorts,
Yeah.
right?
Yeah. No, he had like a very dynamic team that he was running over there.
Yeah, so that is an interesting piece about Jared Vanette. And then before I talk about the GarageBand hedge fund, let's talk about Steve Eisman, who was a really interesting character in the book. Pretty eccentric guy.
Yeah.
But I appreciated. There was a couple good scenes with him in particular. But I appreciated the way that Eisman was portrayed, and he was this strong sense of justice. He really hated when he felt like the little guy was being hurt. You could sense like, and that came out in the book. It's like he did have a genuine care for other people, but he had this internal struggle of like, but if we're right and we make all this money, it's going to be on the downfall of all these Americans.
Yeah.
Any thoughts on the Front Point Capital that you wanted to add?
He kind of added like a little cream to the top by then shorting the. So they sold off their credit default swaps, but they were also shorting the bank stocks,
They were. That's right.
which was probably not as big of a position, not as big of a return on that investment. But he was kind of like once he realized what was going on, he's like, these guys are going to get destroyed.
Yep.
He's like, so let's make that work for us too.
And he did a great job. Oh, I know what I was going to say. I was trying to remember this. One of the really fascinating points too is that, interestingly, he's shorting bank stocks, is that Front Point Capital was a part of Morgan Stanley, and Morgan Stanley almost went completely under. Now they ended up doing a deal with another broker dealer or another bank, but Morgan Stanley, if they had gone under completely, Front Point was actually technically a subsidiary and a part of the balance sheet.
Yep.
So all the gains of Front Point would have just literally gone to Morgan Stanley. And that was sort of a heart-wrenching scene because he's sitting with that one woman that was pregnant and she's the manager and he's like, what's the exposure? And I forget the numbers now because it's been a month since we watched it. But it was magnitudes higher, or maybe not magnitudes, but several times higher than what he thought it would be.
Yeah.
I guess that's magnitudes. And was pretty mortified because I think it dawned on him in that moment of like, wait a second, your overall exposure to CDOs is billions of dollars more than I thought it was. It hit him like, that means that my fund might actually go under with this. Yeah. All that hard work for nothing.
Right.
But then in the end, the banks ended up basically getting, largely bailed out through the TARP program and other programs. So let's talk. Last one that I want to touch on was the GarageBand hedge fund.
Right.
So talk to us about, what their story was.
It was like two young guys who just, they were pretty scrappy, saved up $100K selling gutters up and down the East Coast. Smart guys. And they managed their own money. They had this little hedge fund in their mom's garage or whatever, built up from 100,000 went to like 30 million in a pretty short amount of time. And then they wanted to get an ISDA, right? So they wanted sort of like the license to play at the big
boy table.
Yeah, to do with like complex, nuanced, long-term options contracts,
Because
basically.
wasn't it like 7 years contracts or something?
Yeah, they were. It was
Much longer, and you can't get that with a typical sort of retail
right.
trading
Yeah,
platform.
you can't hop on Robinhood and do that.
No, it's not happening.
It's all because you all build the products yourself. Turns out they were way shy of the capital requirements for an ISDA. But and then like in the movie, it was shown as like they're in the lobby at J.P. Morgan, right, in New York. And then they saw like someone else's pitch book on the table that got rejected. Like they didn't make it past the lobby.
Right.
I forget how they actually found out about
Yeah,
it.
but that wasn't how it happened.
No, but somehow they got word of this pitch from Jared Bennett about the credit default swaps, and then they're like, "This is genius." So then they paired up with Ben Rickert Ben Hockett.
Yeah,
Technically.
Rickart's the
Yeah,
name in the movie, but Ben Hockett, who was a
and
former trader
yeah,
and had his ISDA.
hmm
Or no, he had to go get his. I'm sorry, he had to go get his ISDA.
yeah,
He helped them because of his reputation. He helped them get an
right,
ISDA,
yeah.
and then he was the one who actually did the trading.
hmm But then by the time they were actually gonna get in on those trades, I forget what it was exactly, but like because a lot of people had wised up basically to like, okay, triple B in these MBSs, that's not too hot. People started either had already bought it up or whatever it was, and then they're there at Vegas, right? And then they're like, let's short the triple A's. Because like if it's all crap, it's all crap. Meaning like everyone's like been shorting the triple B's because they're thinking that it's all crap. But like if then why not short the triple A's too?
Yeah, I think they're like not even Michael Burry's thought of that one.
Yeah, yeah. So they ended up taking an even riskier bet. But they'd done their research as well. I
Yeah,
think, yeah.
very analytical, smart guys, done their research.
And the one thing that I like about all these funds, Front Point, the Garage Band, and Michael Burry, Front Point, they're like literally down there in Florida, knocking on doors, saying like, and talking to realtors, like, how did you get this guy the house? Like, oh, they're not working and they haven't made money in years. Like, but they just sold their other house for like, so they're like actually like looking at the asset. Like, I like when there's proximity to the asset, right? And so these investors, they actually like, so Michael Burry popped the hood and read every mortgage.
Yeah,
It's like,
literally
you have a
reading the
credit
mortgage
rating of
contracts.
288, and they wrote you $1 million mortgage. It's like, that's not a good deal.
Yeah, this isn't making sense.
Yeah, and so these guys, they're out in Vegas and they're like, they at the convention, right, for some banking convention.
It was like the mortgage convention, or
Yeah. So they did their homework and they actually like looked at, they checked the car before they bought it because there is a sense of caveat emptor in this, right? Beware the buyer. Like we're gonna, the guy that's selling it to you, and that's I think we are in a very heavy regulated industry, and a lot of that was Madoff. And a lot of that was the '08 situation, right?
Yep.
When people mess things up intensely, then okay, like you're gonna get a rule named after you. That was the joke at college. Like don't get a rule named after you. It's like as long as you like keep it within the bounds of reason,
Right.
they won't have to have an unreasonable rule. Not that these regulations are unreasonable, but yeah, there was like a very large buyer beware atmosphere.
That's right.
Meaning like it's your job to make sure you're not buying a piece of crap. And a bunch of people bought a piece of crap, and then they, made a bet against that.
Exactly. So let's talk for a minute. Any final thoughts that? Oh, I have one more final thought I wanted to say about Big Short, and then I want to just talk for a couple minutes about margin call and a few other final thoughts for us today. So one of the things I disliked about the movie is I felt like, and the book wasn't as much this way. I would say the book by Michael Lewis was pretty neutral. I do think the movie was really trying to hammer home this idea that it was just greed that ran amok. There was a bunch of people who got really greedy, especially with that scene with Mark Baum when he's talking to the synthetic CDO dude. It was, they really portrayed all these sort of these cynical actors that were engaged in grotesque greed, and it was fundamentally that greed led to the crisis. And while certainly there was most definitely grotesque greed that occurred during the financial crisis, I don't think we asked the right question is why. And this is something that when I bring in additional scholars here, bring in some real scholars to talk about this, it's way deeper than humanity just all of a sudden became fundamentally greedier.
Right.
I felt like that was a big miss of the movie, except for one scene. There is the scene with Mark Baum, Steve Carell, Eisman in real life, right? Steve Eisman. there was this great scene. He's sitting on the porch, and they're like begging him to sell off the credit default swap on the secondary market to make their money. Right. Because one of his traders was encouraging him to go ahead and do that because there was that creeping fear that what if the banks failed, then we're going to get nothing back for the CDS. And then they found out there were the bailouts. And there's this scene, like an epiphany for Mark Baum of like, they knew all along. They knew exactly. They're not idiots. They knew exactly what they were doing. And what he's referencing is this concept of moral hazard.
Yeah.
They were willing to take excessive risks, knowing that there had been a long precedence of bailouts in our nation. And I think a major part of this, and we'll talk about this in future episodes, was the breakdown of the hedge fund long-term cap management in the late 90s. That was a watershed moment where the Fed sort of secretly intervened and bailed out long-term cap management. And what they did is they sent, I believe, a green light to the rest of the industry that it's okay to take a lot of risk because if you go too far, the government is there to bail you out. And that is an idea known as moral hazard. That is something that Ben Bernanke has written about, that he recognizes that one of the problems of the bailout measures that he, and at the time, Timothy Geithner at the New York Fed and Hank Paulson at the Treasury, they were worried about moral hazard. In fact, they got so angry in all the press conferences because they were constantly asked about moral hazard. They were fully aware of the fact that their measures could lead to future moral hazard. We'll talk about this in our next episode because that was something that Hank Paulson, by the way, as a quick aside, was really afraid of moral hazard. He's like, we're not bailing out Lehman Brothers. In fact, his whole reason for initially not allowing, his reason for really allowing more, there's other reasons, but one of the reasons why he let Lehman Brothers fail is he didn't want to send the signal of moral hazard to the markets, that we're always there to bail them out. But that is something that, back to The Big Short, Mark Baum's recognizing at that point that this is a problem of moral hazard. He's verbalizing his frustration that they all knew all along, and they weren't idiots to take the risks that they took. And then at the end, I believe it was in the epilogue at the end of The Big Short, he does acknowledge that there were other factors that led to this greedy behavior. So to Michael Lewis's credit, I feel like he acknowledged that. My big beef, I'll say it again, is the book really kind of paints it as everyone really got really greedy. And I think for the average person who doesn't have a deep understanding of the financial crisis, when they're watching these movies, these Wall Street movies, they're walking away with this narrative that it was just greed. And I think if you're listening, you deserve a much better answer. Because to me, that's dissatisfying. Because by the way, we haven't always had this amount of banking instability and financial instability in the global economy. It's actually gotten significantly worse. And so I don't believe, and this is a question that Charles Calamiris asks, that who we will have on here soon. He asked the question, do you think humanity is fundamentally greedier today than it was, say, 50 or 60 years ago? No. There's a bigger story to this whole situation. Margin call real quick. That was not a real story. So that was a critique of Wall Street. It was really about all these traders that recognized that these mortgage-backed securities CDOs were going belly up, and they decided they wanted to exit and get out of it. And so this broker-dealer moves very quickly to just get out of this. It was a banker, an investment banker. They were moving very quickly to just get out. The reason the story is not real, though, because I read up a whole bunch of reviews, and the reviews were, oh, this is Lehman Brothers. But it wasn't Lehman. It couldn't have been Lehman Brothers, because in the movie, they got rid of their toxic assets before the rest of the market knew that they were toxic assets, where Lehman Brothers didn't. Lehman Brothers was holding on to those things. They were white-knuckling all the way down. And in the end, because they didn't actually offload those assets, they basically became casualties. And then if you look at all the major investment banks in the United States at the time, none of them basically did that. Maybe some of them at a certain point offloaded a portion, but that's where the movie is. That is a very fictitious movie.
Right.
The Big Short is very much based on real life. It's based on the events of a true story. There were some liberties taken, but it was a real story. Margin call was pretty much made up, and even the director, I ended up finding some information, and the director said this is really just a critique on Wall Street and some of the behaviors that had occurred. Because some people were saying it was Goldman Sachs or it was Lehman Brothers. If you actually understand the crisis, it couldn't have been either of those people the way that storyline worked. Any thoughts on margin call that you wanted to share?
It was it gave an interesting look at the inside of the institutions that we saw the outside of in Big Short.
Correct.
It was a different perspective.
Yeah, I agree.
And they didn't really get into, they didn't say CDOs, they didn't say MBSs. It wasn't they weren't really trying to educate.
They said it
on.
once, by the way. It was
Really?
just in the scene where the cavalry comes in and you hear the helicopters and the CEO shows up and is the British guy. He shows up and they're in the big conference room and they're trying to understand the risk to the firm. And he does just say, we've packaged CDOs and MBSs.
Oh, okay.
But that was it. I mean, they literally touched on it for a millisecond. Yeah. So to your point, they didn't get into helping a listener even understand what they were trading.
Right.
But go ahead.
Yeah, but it did show an interesting perspective of the inside, like how are we going to put this fire out? And then it was, there, and then the sales manager, the sales director of sales, he called all the guys into the room and he's like, this is going to ruin relationships, but we're going to give you a big bonus if you hit your numbers. We need to dump everything. And so you just saw scene after scene of them basically dumping bad bonds onto in Wall Street, in that sphere of the institutional trading, whether that's bond traders or credit default swaps or whatever it is, it's not that many people that trade in these products, right? You might have 120 guys in Manhattan, and they all kind of you all sort of know each other. And you develop these relationships, and then so they were like really souring like a long-standing relationship by dumping crap on their buddies, basically.
Yeah.
And yeah, I don't know if the bank didn't really make it at the end, did they? I think they got, it said they were closed for, it was accounting fraud later on.
I see.
Yeah.
I mean, and so I can see where this maybe could have been indicative of some of the major investment banks. Mm-hmm. So maybe it was similar to what Lehman Brothers was doing. But again, because all the reviews I kept reading kept saying, oh, this is a critique of Lehman Brothers. But Lehman Brothers actually didn't offload.
Yeah.
They were hanging on. In fact, we'll talk about this next time. They were really hanging on to those assets and even pitching them to outside investors because they were trying to get an outside investor to take a stake in the firm to keep them solvent.
Yeah.
And they were pitching at one point, the Dick Fold, who is the CEO, was almost pitching those as good assets. I still believe in these. This is part of, don't give up on these assets. There's a whole sort of storyline there. So that's where, okay, margin call really wasn't about Lehman Brothers, what they were saying. Yeah. But I think to your point, they're sort of showing some of the toxic nature that did exist at the time with some of these investment banks and the traders inside of them. And the ability to ruin relationships and to savage other firms. I think that was very much real to the dynamic of the environment at the time. Mm. And so I guess it was a satire or a critique of the toxic nature. And to that extent, the movie was quite accurate, I would say.
Yeah.
Any final thoughts on that?
No, I mean, go watch
Go watch them.
Yeah, I'd recommend watching it. Yeah,
I think both movies are great. I enjoyed them thoroughly. Obviously, we have some critiques of them. I think Big Short is a much better movie compared to Margin Call.
Yeah,
and I think it is much better at actually explaining the events of the 2008 and 2009 financial crisis as it pertains to the financial instruments. Mm-hmm. They don't explain a lot of other stuff, but they explain the instruments and they explain the shorting, which was basically the final straw that broke the camel's back that led to the decline. Let's talk about short sellers for a second, and then we'll wrap this up. And I'm going to share a few thoughts, and I'd love your feedback, sure. Pat. Something that came up in Too Big to Fail, and also came up in the movies, was a lot of frustration, not so much in Big Short, but definitely in Too Big to Fail. A lot of anger from these major banks that were being shorted. There was frustration that because Dick Fold, by the way, at Lehman Brothers was really calling the SEC and saying, you need to go after these short sellers. Mm-hmm. They're unfairly in a predatory fashion ruining a perfectly healthy bank. And so there was an immense amount of outside pressure to stop the shorting. There was an immense amount of pressure to shut down the credit default swap. And that's because they had a conflict of interest. And I still think even to this day, and this came up also in Too Big to Fail, is who's the Jim Cramer. Jim Cramer at the time, and I don't know if he's still, I'm assuming he still is, was a huge critic of the short sellers. He just thought these were these horrible creatures that were harming all these innocent people. And my critique of the Jim Cramers and my critique of people who don't like short sellers, I'm speaking as someone who largely operates in a long capacity. We do use some hedge products. We're getting more and more into hedge strategies. There's an important role for that. But even for me, historically, I have more of a history, different business. Like Michael Burry was running more institutional, and I'm more of a retail person in wealth management. But I've kind of been a traditional long investor for most of my career. So I'm not like super partial to short sellers, frankly. That said, I see an inherent value to short sellers because what a short seller does is it forces the markets to correct and move back to equilibrium, because a good short seller has the foresight that Michael Burry does to realize something's fundamentally wrong with the economy. Yeah. And if something's fundamentally wrong, I have the mechanism to help it correct and move back to equilibrium. If you don't have short sellers, and I feel passionately about this, if you don't have short sellers, you will have worse crises. You will have more crises. They will be broader, bigger, and more destructive to the American people. Because if you think about it, if there was no credit default swap, if there was no shorting the bank stocks, how much longer would that have gone? Mm-hmm. It took forever for it to pan out. Even when the rating of the mortgages were starting to decline, Pat. Right. Remember that? Yep. The values of the underlying mortgage-backed securities and CDOs were still going up. Yep. Right? They were so frustrated because it felt so fraudulent. And that was the point where, they're like, this is fraud. These people are fraudulent. We need to sue them. We need to sue all these people. That's why the short seller matters, is because they're able to spot and help correct a dysfunctional market sooner.
Otherwise, it's like the emperor's new clothes.
Yeah. How do you feel about the importance of short sellers?
No, yeah, it makes sense to me. If everyone rides the euphoria, this is kind of like, they're calling them meme stocks, right? Where, companies, the price runs up and up and up and up because of, and oftentimes, sometimes it's based on fundamentals but you kind of need a balancing act. You can't have everyone. It's good to have a couple of people scratching their heads and saying like, no, I think you're wrong. And then that makes the people that think they're right say like, let me look into this further. And like you were saying, it makes the market go back to equilibrium where companies are priced at their actual value. So yeah, I completely agree with you.
Last point is when you have bubbles that are forming, right? So we had a real estate bubble. We had a tech bubble. We had, a couple years ago, we had a cryptocurrency bubble. There's probably another bubble lurking in the future because we printed $5 trillion and then had trillions of dollars of spending packages under the past couple presidential administrations. When you have bubbles that burst, the reason that they eventually burst is that resources got allocated to the wrong parts of the economy. Yep. Iron ore, coal, gas, nuclear. I mean, it could be any resource, right? Between the beginning production goods all the way down to intermediate to final, consumer goods. If resources are getting diverted in the wrong directions, that means that is going to eventually blow up on us, right? And maybe those resources should have been diverted in a different direction. If you don't have, so here's what a short seller in my mind does. And I hope I'm explaining this okay, is when resources are moving to the wrong place because of speculative bubbles, because of bad market signals, what's happening is that is not being moved to the more productive place. And what a short seller can do is it can actually help in a quicker time frame redivert resources to where they actually should be going, where true market demand will exist in the future, as opposed to the speculative place. Mm-hmm. When you remove the short seller, you allow the bubble to get bigger and have a bigger impact when it does indeed burst.
Yeah, I agree.
So, all right, man. I know it's been a little long. This is great. Final thoughts.
Yeah, watch the movie.
Yeah, agreed. I think they're both great movies. We'll be back in few weeks, we're going to kind of stagger this series with other episodes over the course of the year, but we'll be back in the future with a podcast episode on Too Big to Fail and the bailout measures. So, Pat, thanks for being here today, man.
Thanks for having me.
All right. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. The expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.